And joining me now is Martin Smith from Anchor Capital to share his analysis on the day's market performance. Martin, thanks so much for your time this afternoon. Can you believe we're in the fourth quarter? What a year it's been. Just take me through what you'll be looking out for in this quarter. We do know that, of course, tariffs still making headlines. There's also been a major shift in the US after the Fed cut rates. So we are also looking out for that dovish tilt and how many more cuts could be coming through on that side.
Yeah, I think it's been a bit of a crazy year. I think obviously we've had a bit of a bull run locally and offshore, but I've never felt so uncomfortable during a bull run, if that makes sense, because there's just so many things going on in the background, day to day, week to week, month to month. It's always felt quite kind of uncomfortable, especially when you look at where valuations are specifically in the States. So it's been a bit of a tricky year, but I think the old adage of stay invested, be invested in good quality things, and you'll make returns is kind of held true. But again, it's been definitely been a bit uncomfortable. But like you mentioned there, I think it's about interest rates, it's about inflation and tariffs, politics and political gesturing. Like there's still all those things kind of sitting in the background. And again, valuations are still quite high. So let's see where the market goes. But it's nothing new from what we've been dealing with for the last kind of 9 months or so.
And just sticking with, news out of the political scene, the big news out of the US, of course, is the federal government partially shutting down after Democrats and Republicans couldn't agree on a spending plan before the new fiscal year. This, of course, affecting government agencies like firms responsible for compiling economic data, important economic data that informs both investors as well as policymakers. How concerned are you about this move? I mean, there is talk that we probably won't get that September jobs print on Friday.
Yeah, probably not, is my view as well. I'm in agreement with you. And that was quite an important number because obviously, like I mentioned, there's a lot of uncertainty for the last kind of 6 to 9 months. So we're kind of hanging on to every bit of data that we can get. So that's a bit disappointing. But I mean, these things do kind of rear their heads from time to time. And there's a bit of political posturing and gesturing and all of those things. And they don't tend to last terribly long. But again, it's just one more thing in the kind of list of uncertainty. So you've seen the market behaving a little bit all over the show, down initially last night, then finishing up at a kind of index level. Although I think if you look across the board, there were a lot of companies that were down quite a bit, especially on the gambling side of things. So futures down again today, gold up again. So that just speaks to the fact that there is uncertainty. I think the market's expectation that this will get resolved at some point is there. But until it does, that uncertainty will kind of remain true, which is, again, what we're seeing now from an equity versus gold kind of equation.
Now, uncertainty aside, the mood back at home in the manufacturing sector is looking up and back in expansionary territory for the September period. Now, that industry particularly volatile with those US tariffs, of course, in play. Talk to me about the shift that we are seeing in morale. Are industry leaders coming to terms with the kind of environment we're in where you sort of have to maybe rely more on domestic demand?
Yeah, potentially. And I mean, look, the numbers that were out today were good and were ticking up in the right direction. But as you know, it's month to month, like you mentioned, I agree with you. It can be volatile and these things can be a bit lumpy. So some months it looks good, some months it looks bad. I think what we need to do is look at it kind of an overall trend type of perspective. And I think it doesn't really tell us anything that we don't know. If we look at the kind of longer term trend that we are struggling, and you mentioned there, we are a little slow. We do have kind of challenges ourselves, and it is about trying to find ways to get growth kind of across the board in South Africa. So yes, it is a positive number. And I don't mean to be negative and say that it doesn't mean too much, but again, we've got to look at the kind of longer term trends, and what we do know is that we are in a little bit of a tough and tricky position with tariffs or no tariffs. We do need to find some growth from a GDP perspective kind of across the board.
I mean, you make really valid points there, Martin, because we are also dealing with the ports issues here at home as well, downbeat growth. So it'll be interesting to see how, the shift in sentiment also filters through to those production numbers, I guess.
Yeah, absolutely. And I think we all got so excited. It was around about May last year, kind of post-elections, and everyone was talking about this kind of 2, maybe 2.5% GDP number that was going to come out for this year. And everyone was getting really, really excited about it because 2% is kind of the magical number where things really start to, from a real perspective, actually start to grow, and there's job creation, all those things. And then we've just been revised downwards and downwards, kind of every point we get, it's been revised downwards and downwards, and now I think we're about 0.8% GDP growth expected for this year. So it's been a little bit disheartening from a South African perspective, but we're resilient, so hopefully that can improve, and we can find ways to kind of sort that out going forward as interest rates come down and inflation goes down, all of those good things. But yeah, we need some growth in the country is for sure.
Now, a company that has been shooting the lights out in this, downbeat economic environment is Capitec, really not showing any signs of slowing down, with earnings up over 20%. Of course, adding more customers and that diversification strategy continuing to bear fruit. Just walk me through your analysis of those numbers. What did you make of the 6 months that was for Capitec?
Yeah, you hit the nail on the head there. Just a strong set of numbers across the board, and actually better than what the upper end of what they guided to going into these results. Revenue at the top line good, bottom line numbers very good. The ROE at 31%, which is incredibly strong. Like you mentioned at the beginning of the show, I heard you saying 25 million customers. It's just been a really strong set of numbers for them, and they're also tracking nicely ahead of what consensus is expecting them to do for the year, which is about 22% HEPS growth. So just all around good numbers, kind of across the board. You just see some price cuts affecting the business side of business banking side of their business, taking the shine off a little bit, but otherwise just very, very, very strong. And I think you've seen the share price react accordingly, up about 3% before I came on air with you guys. So still only 14% for the year. I think SA Inc. needs to play a little bit of catch up with NASDAQ, telcos and gold. Hopefully going into the last 3 months of this year. But yeah, like you mentioned, just a really, really good set of numbers, and they continue to deliver. So yeah, good to be a Capitec shareholder today.
Yeah, I wish I had that 3,000 Rand, Martin, but unfortunately, that buzz has left me. Let's hit pause on the conversation before we get to your stock pick. Let's take a moment to touch on which counters your industry peers are watching closely.
We are seeing that the Chinese decoupling from US technology and AI, I think that is a massive opportunity for Tencent, Alibaba, Baidu, those main players in China, and that gives a very strong underpin to process. But furthermore, I think we've seen with the new CEO, the execution has improved significantly, capital allocation has improved significantly. So you're looking at delivery businesses, you're looking at the classified. There's been improvement in margins, there's been stronger growth, and like I say, the capital allocation has improved. So I do think that it does give confidence about the outlook for the future. You're going to get a free ride on the Chinese wave of AI improvements.
I think Motus is nicely positioned. I think they've climbed the wave of the Chinese competition. They have some of those Chinese dealerships. They've also got a big investment in the aftermarket because as the cars get older, they need parts. They've become almost the biggest distributor of those aftermarket parts, both here and in the UK. I think over the next couple of years, you'll see them deleveraging, widening margins, and increasing their presence in that aftermarket. And that just compounds earnings growth for them off this very low multiple. So I think it's one that's been ignored, but I think one that's poised to do quite well over the medium to longer term.
All right, so JSE listed companies Prosus and Motus. What's your take on those counters?
Prosus, Naspers, we really like. You obviously got the Tencent side of the business growing extraordinarily well, still looking relatively cheap, kind of 20+% earnings growth from here. So we really like that. You've obviously got the other part of the everything but Tencent also starting to kind of come into its own. So very much on board with that idea. Motus is an interesting one. It's a little bit debated inside of our office because you've got some guys saying it's fairly priced. It's a very competitive environment out there. It remains to be seen what happens from a kind of price to volume perspective. And other guys are saying, look, the share is trading on a 5x multiple, growing at 10%, dividend yield of 4 to 5%. So it's actually looking quite attractive from a metrics perspective. So it ranges in our offers from buy to neutral. So it's an interesting kind of debate that's going on there. But still, I think quite a nice story. The process one, yeah, we like and we're on board.
All right. So what else are you liking? What's your stock pick today?
I've gone for Constellation Software. So, I mean, it's a business we've liked for a long time. But you have seen a bit of a kind of sell-off in the business in the last few weeks. Kind of two primary reasons. One is the fear and nervousness around software businesses with AI coming in, all of those things. The other one is the CEO, a long-standing CEO, has stepped down due to health reasons. So you've seen the share come off quite a lot in the last few weeks and months. We think this is quite a nice entry point. They've been phenomenal management team that's delivered kind of consistently, free cash flows up 20% consecutively for kind of 20 plus years. They're growing at 20-25%, forward PE of 25 times. So I think it's quite a good entry point for a good company that is delivering and has delivered well. And I think has just got caught up in a little bit of a sell-off. But yeah, I think that's a nice one on a medium-term view.
Constellation Software, one to look out for. Martin, thanks so much for your time and taking us through trade at midday. Now that was Martin Smith from Anchor Capital.